Welcome back to the Scholar Wolf podcast. Evan and I are back for another speed round. Steven is handing us the mic again this week to work through a batch of short questions. We've got Steven lined up today, covering everything from individual bonds versus bond funds at scale, to private credit as a diversifier, to how to evaluate a whole life insurance pitch, plus a few other funding topics. So let's get into the first one. My current portfolio has approximately $5 billion in total assets. Roughly 20% is invested in a Treasury index bond, and the rest is in equity index bonds. As a person's bond allocation grows in value, do you see any role for investing in individual bonds, either treasuries or corporates, rather than continuing to use bond index bonds? So, as we kind of break this down and think about it in different ways, I think there are a couple of scenarios where either can make sense. So, for example, we like to use for some of the clients who are thinking longer term, sometimes bond index funds can make a lot of sense, right? What it kind of does is the index fund will go and buy the new bonds, and the interest rates will change, and accordingly the price of the bond index fund can change, right? So I think this works really well if you're looking for simplicity and reducing the complexity in the portfolio. And that way it almost creates something that acts like a bond ladder, but you're not actually going in manually and buying those bonds or trying to evaluate the price or whatever it is. It just kind of takes care of that for you. So I think that works really well from a long-term perspective, especially if you don't need the cash immediately. You have a separate short-term reserve of cash, and you're just kind of setting your bond course of the portfolio. Where it would make sense to kind of go individual on the fixed income, I think makes sense when you have a specific liquidity need, and that way you can match out the maturity of the bond to the liquidity need. And that kind of mitigates the risk. If you're going a bond fund, it's not a complete stable value, right? And net asset value isn't necessarily going to be one like it would be something like a money market fund. And so it mitigates the risk a little bit of the minor fluctuations that would happen if you had a specific liquidity. And that's where I think it would come in to buy an individual bond and not just the maturity.
Yeah, I agree. I think when you look at individual bonds versus bond funds, you're kind of managing dates on the calendar with each individual bonds. You have a liquidity need for the future, whether that's 3 years down the line, you're trying to pay for education, or you have a car need in your future. Again, you have individual bonds that mature at the time that you need that liquidity. When you look at bond funds, now you're trying to manage risk in your overall portfolio. People get confused though, is with interest rate risks. You see that a lot with the bond funds, and that's what you're trying to avoid with individual bonds. That's not to say that interest rate risk is going to mathematically go away with the individual bonds, but what it does do is becomes less economically relevant to you. Doesn't matter as much if interest rates rise and your bond decreases in value, because you're not looking to sell it at year 2 or 3. You're looking to sell it at maturity or wait for it to mature, and then you get the principal value back. And that's when you actually need the liquidity. That's the whole idea with the bond value. You're trying to line that up with your needs.
Exactly. Kind of building off what Evan said there, I think that's one of the key misunderstandings or things we have to get straight is that if you're buying an individual bond, you don't see the price fluctuating every day because you buy it. And if you think I'm just going to hold it to maturity, you don't have to sell that. That need isn't there to evaluate the market value of it. And if you're holding it to maturity, it doesn't matter to what's right, just like we said. And that's where the use case comes in. But I think the fluctuation in market price doesn't just go away just because you don't see it, because it's, there's the interest rates that are changing also, which actually on the market value perspective does change the value of the bond or the bond fund. It's just that when the price ends up dropping or something in a bond fund, it's because it's reinvesting at a higher interest rate, which eventually over time works itself out. You just don't see it with an individual bond. All right, on to the next question.
I need to put some cash to work in my IRA, and I have a 15-year plus horizon. I've narrowed it down to QQQ or MAGS. My account is already 80% BTI plus a couple of check thematic ETFs. My thinking is QQQ overlaps heavily with what I already own. So should I go to MAGS to tilt on those specific names? I think when you look at this, you are kind of a portfolio construction question, and rather than a concentration risk, in the sense that VTI is already heavily concentrated in these growth funds. It's still broad market ETF. You get exposure to large cap, small cap, mid cap, which is good. And it's not as concentrated as funds that you would see. It's QQQ, MAGS, which is a Mag 7 ETF, but it is still heavily tilted towards growth right now. And when you try to double down on your bet for these growth companies, it's not a bad bet to make, but you have to understand what your risk is now. The big thing that's happening to tech funds is there's a difference between business risk and valuation risk. No one's saying that NVIDIA is going to kind of close their doors tomorrow or Amazon is going to suffer a major loss. That's the issue that people are really looking at now, is that, well, if these companies are so great, then why can't I just buy their stock and it's going to be fantastic? Well, the valuation risk is what you're worrying about, that people are already valuing into the equity, these perfect scenarios into the future, and these perfect scenarios don't come to fruition. Well, you're down these companies, whether they're great or not, is going to kind of fail at the end of the day.
Yeah, I think that's a really good point. I think another thing we see is BTI is hardly concentrated. We know that the concentration already kind of tilts toward that growth in tech and stuff. So whether you're evaluating QQQ or MAGS to layer on top of BTI, either one of those kind of has that same attribute of roulette, right? So I think a bigger question could be, if we're looking for some kind of diversification, maybe you would tilt something more like small cap growth, or small cap value, or maybe even international, if you have a long-term horizon. Because if you go, whether it is QQQ or MHES, both of those are overlap, I think. And MHES would just be more and more concentration if you want that. And thinking that maybe the moat that has been created by these larger firms allows for things like more innovation, and that the winners will continue to win. But I think it's also worth evaluating whether diversification in another high risk asset class makes sense, like small cap or internet.
Yeah, I think that's where the difficulty comes in for mine. QQQ versus a Mag 7 ETF is that QQQ is still a growth tilt, but a Mag 7 is from just 7 companies, and now you're betting on 7 companies remaining at the forefront of the AI build out. And all these companies are going to be reliant on AI, data centers, cloud computing, and all of them are so concentrated on the same engine that the engine starts to fail a little bit. You have no backbone to your true portfolio.
Yeah, absolutely. All right, on to the next question. Private credit and crypto feel like the two most disliked asset classes right now. And in my judgment, that's where the opportunity is. Crypto is not my thing, so I want to start positions in private credit. The best risk managed way to do it seems to be a fund that spreads across multiple asset managers with no one manager making more than 10% of the fund. I'd use it to replace a small piece of my equity sleeve with the idea of bringing down volatility without sacrificing returns. Looking for suggestions on how to figure out it. I think that's a really interesting question. I think anytime you get into alts, something like private credit or real estate or whatever it could be, you got commodities out there. There's a lot of ways you could diversify, right? So I think there's a couple of things to touch on. I think I agree with, if you're going to replace a portion of the portfolio, I think equity is the way to go. Private credit, even though it is credit kind of on the debt side of things, it's not necessarily riskless. I know a big part of the controversy recently has been, who are we actually lending to? Is it kind of, has the due diligence really be done as far as whether this person who is borrowing or this firm that's borrowing can actually pay back the debt? So that's really one of the first questions. Another thing I want to touch on is the volatility piece, because as far as visible or perceived volatility, private credit may have an advantage over something like public, but part of it is whether it's being marked to market or not. So for example, if you look at a bond fund, that's being marked to market daily, right? At least. So, or more than daily. So you constantly see any fluctuations in value. The difference in private credit is if it's being, appraised on a rather infrequent basis, it may appear that there's less fluctuation in the price, but in reality, the risk may not actually be lower. So I think that's an important thing to remember when we're thinking about private credit. Another thing is it's nice to have the diversification benefit of spreading across multiple managers, even in this asset class. But the one thing to remember is any excess return you may be earning, not only are you paying each fund manager, but then or each private credit manager, but you're also paying the fund a fee too. So that's going to kind of heat in the returns. That kind of hurt the appeal of the strategy a little bit.
Yeah, I think you did a good job of separating the volatility and lower economic risk. Just because you don't see the volatility doesn't mean that the volatility doesn't exist. I've always heard that when you look at private credit, it's like taking a temperature of a person, whether they're healthy or sick, every 5 minutes or every 3 months. And that's what's basically happening in private credit compared to public debt. You get to see every single volatility every minute, every second of this public debt. But when you go to private credit, it usually gets kind of revalued quarterly. So every 3 months. So when you take a person's temperature, you could take it every 5 minutes and you find out when they're sick and when they're healthy, or you take it every 3 months and you just think they're healthy the entire time. So when you look at that, you go, oh, private credit's a lot less volatile. It has to be a lot safer. And that's not necessarily the case that we start looking at. Private credit is in under a little bit of a microscope now, just because of everything that's happening. And that comes from also the illiquidity premium that a lot of private credit comes with right now. That should not be seen as free alpha or a free return. People get the liquidity premium because your credit or your bonds in your portfolio is supposed to be something that you lean on in uncertainty. And then when you try to lean on that in a bear market, well, now the fund is going to say, well, you can't take out your entire principal or whatever we promised you could take out quarterly because everybody wants to do that. And then that's where the shock absorber that debt and bonds are supposed to be in your portfolio, that's where it kind of falls apart in times that you actually need it. So, now on to our next question. I've been maxing out my HSA for about 6 years and haven't touched it. I pay medical bills out of pocket and save receipts. Everyone tells me that's the play, but is that actually worth it, or am I making a complicated mess for myself down the road? The HSA is probably one of, if not the most tax efficient account for retirement, retirees, or anybody really. It goes in tax deductible when you put into the HSA. It grows tax deferred, and then if it's used for medical expenses, it comes out tax free. So it's super beneficial. The difficulty is that if you have receipts and a shoebox in the back of your closet, that's not really going to hold up it an IRS audit. So the difficulty for HSA and keeping track of all these receipts is making sure that you have a robust spreadsheet and that shows whether out of pocket, making sure that insurance didn't cover it, you didn't get any deductibles on that for your tax return that year. And that's where it becomes really problematic for people down the road. If you're not willing to spend the time now organizing those receipts, then maybe it's not worth the tax benefit that you get down the road. It shouldn't. The complication now shouldn't give you a headache later on down the road when you're actually trying to pull it out. A lot of people also spend years growing the HSA, paying out of pocket. Like you said, a lot of people say that's kind of play, which it is. But if you get to end of plan or died with the large HSA and you die after your spouse, now your heirs inherit this large HSA, which is all taxable income the year that they inherit. So these are all problems that come for the HSA, and that's not to say that it's not a fantastic account, but it does come with some complications. And at the end of the day, you have to weigh whether those complications are worth the tax benefit to you.
Yeah, I think that's a really good point. I think from an advantage standpoint, it definitely does help. Like Evan said, it's triple tax advantage, right? So you get the tax deduction of the front end. It's tax sheltered or tax deferred through the growth, and tax free distributions for qualified medical expenses. Definitely the benefit of keeping those receipts is it doesn't have to be a medical expense for retirement. If you keep those receipts and they were qualified medical expenses, that kind of frees you up once you retire, I think, to pull those dollars out tax free, right? So that's definitely the main advantage. But I think that's a really good warning too of you can't double dip, right? If you're reimbursed by insurance or you took a tax deduction for those medical expenses, you can't go back and use the save receipt and pull that out tax free. So that's definitely a good word. But on to the next question. I've got money spread across a taxable account an IRA, and a 401k. When it's time to rebalance, do I do it in each account or look at the whole thing together? And how often should I actually do this? This is a fantastic question and definitely something that we address in comprehensive planning. So I think when you're asking about optimization, right, that's when we kind of not only look at asset allocation, which is more frequently known or commonly known kind of strategy or thought process. What we look at a lot of times is tax location, which basically says based on the tax treatment or the tax consequences of the underlying asset class, what is the best way to place those across the aggregate portfolio? So it's not just saying, okay, maybe I have a 70-30 portfolio with 70% equities and 30% bonds. I'm going to allocate each account like that. That is completely fine to do. But if you really want to get granular, what you can do is place things like bonds, which are going to generate coupons and taxable income inside of those tax deferred vehicles like a traditional IRA or a 401k, for example. And then in those taxable accounts, maybe you're orient those more toward growth of things that don't produce taxable income. Again, like bonds, we would want to keep out of the taxable accounts, and maybe something like small cap, we would want to throw in there. And then obviously with the Roth IRAs as well, those are never going to get taxed again. So maybe that's the place where you want to put your highest growth assets. Again, don't throw off the aggregate allocation. We're just being smart about where we place those asset classes, but at the same time, they can create a little bit of alpha. I think research has suggested somewhere between 5 and 30 basis points on an annual basis. The one thing I do want to war against is there is a pursuit of optimization in this area where we could say, okay, perhaps I can earn 30 bips a year in alpha via tax location, right? Which is smart. The one risk that gets introduced, which maybe this would make you think twice about maybe introducing some oversight or working with your advisor. Because if you're doing it yourself and if you're not super careful and you miscalculate things or throw things off a little bit, you wouldn't want to throw up your aggregate asset allocation just in the pursuit of a little bit of alpha, because it's easy, I think, if you're setting every account with the portfolio aggregate allocation target, it's easy to keep track of it. But if you're really trying to do an elaborate tax location strategy, sometimes it could be easy to throw off your aggregate numbers because not everything looks the same. And so what you wouldn't want to do, for example, is target a 70-30 aggregate portfolio, and somehow you accidentally end up 85% in equities and 15% fixed income in pursuit of a 30 basis point annual tax alpha. So I think that's something I would warn against. But at the same time, if you have some oversight or you know you're implementing it correctly, I think it's worth it from an optimization standpoint.
Yeah, when you go into kind of forgetting, kind of mishandling your accounts or holdings, you also get into wash sale rules that say, well, now I'm going to kind of rebalance my portfolio. I'm going to go to the taxable brokerage. I want to rebalance it. Let's harvest some losses. And you harvest $5,000 worth of losses, which is great. How you have areas to sell some positions that have maybe gained over the years and now going to mix it up. The problem comes from the accounts might be treated differently and the accounts might have different holdings in them. But say you have a like account in both your brokerage and your IRA, and you say, well, I'm just going to click at the beginning of setting up my IRA, reinvest dividends. Well, all of a sudden you're going to reinvest dividends in your IRA, and the $5,000 tax loss opportunity that you had in your taxable brokerage all goes away because you have a $5 dividend in your IRA. So making sure that you rebalance and per household, making sure that you rebalance correctly in each account, but understanding that all these accounts work together. Like you said, you made a good example of the difference between asset allocation or what you own and then asset location where you own it. But it needs to be done together. Household rebalance this should be done together because that's going to get a little bit more complicated. Pointed out, maybe it is not worth the hassle of trying to save 30 bips if you just have all the accounts allocated the exact same way. Simplify things a little quick, but you have a good advisor, you have a team that understands the benefit of asset location. It is certainly a beneficial thing and something you get free alpha from. And on to our next question. I'm in the top tax bracket, and my broker keeps pushing me towards municipal bonds for the tax-free income. when I look at treasury yields and back out my taxes, I'm not sure munis actually the better deal. What am I missing? For one, you might not actually be missing anything. Just because it's tax free doesn't necessarily mean that it's superior, and definitely doesn't mean that it's less risky. So when you look at the tax equivalent yield, you should be looking at if it is a better opportunity for you in the tax sense, but also on the risk sense that you have. If you back out your taxes and do a tax equivalent yield thing, then the municipal bond is yielding a higher return. There's also a reason why it's yielding a higher return. You're not getting a free lunch in that sense. There you have added risk if you're going to get a higher return. The other thing to understand is that municipal bonds exist per state, and making sure that you do the right tax equivalent yield as well, getting rid of the state, local taxes, depending on where you're able to invest and what bonds you're able to gather up and invest into is also important. And that municipal bonds are not a blanket to throw over a whole asset class. There's very different. Municipal bonds vary by location and creditor and who's actually offering the bonds, and understanding that these bonds are not risk free. They come with creditor risk, they come with callability, and that these added risks should warrant added returns, but those added returns increase the risk in your overall portfolio.
Absolutely. Yeah. And I think it goes back to that basic calculation too of tax equivalent yield. Like, I think conceptually, right? You learn about municipal bonds. And if you're just kind of going back and forth and chat with somebody, it's like, man, it's tax free, boom. And then go to the next day, oh, I'm going to do this. It's like, it definitely makes a lot of sense to go back and actually calculate on a tax equivalent yield basis. What are you getting from the municipal bond? Because it's easy to say, well, I'm in a relatively high tax bracket, right? I'm a high earner, so it must make sense. I need the tax free, But until you actually go run that calculation, also, maybe they only make sense if you're absolutely maxed out and you're almost there, but you're not. And then even in that case, like sometimes you have to run and say, okay, the excess yield on a tax equivalent yield basis is going to be 5 basis points. To throw municipal bonds in there, maybe there's excess credit risk. Maybe the duration doesn't match what I actually want. And then on top of that, the complexity you're adding to the portfolio, like would it be better to just throw it in a money market fund and call it a day? It depends kind of on what the yield is. So I think you have to kind of measure all those factors. Yeah, before you make the decision.
Yeah, I think you're totally right that just because tax free can help a return, it doesn't help a bad investment. So we're understanding where this investment is coming from, at the added risks that comes from muni bonds or treasuries or corporate bonds. These all have to be factored in, not just what's the impact or the yield. And that's the only thing that you're really focused on.
Absolutely. I'd stare with the next question. An insurance agent has been pitching me on a whole life policy as a way to build tax-free retirement income on top of my 401k. On paper, the illustrations look great. What should I be watching out for? I think that this is a really, really common dish to be had, right? I think a lot of times you get in there and there's elaborate pitches. They kind of build the narrative. Okay, you're good to go. You got your 401k, you max it out. We're not worried about that. Now you've got the decision to make. You've got a taxable account, right? And then you've got maybe whole life insurance as a different way of invest. I think it's interesting. There's a few considerations. One are the underlying assumptions. If you're kind of building a narrative and you work for an insurance company, for example, what is the best way to build that narrative in favor of the whole life policy, which, as you may know, sometimes for the same death benefit amount can be 10 times as expensive on a premium basis, right? So how do we kind of pitch this and make it make sense? Not to say that they're all bad, right? But I think a lot of it comes to the underlying assumptions as far as what the tax rate is. If you're investing in a taxable account, I guess assuming like the highest marginal rate, for example, so you have less being invested in the taxable account, and then kind of what the taxes look like on the back end as well, and then even market returns, right? Because if it's a whole life policy and it's not variable, you've got the guaranteed cash value increase, which is guaranteed. That's true. But maybe there are some assumptions in the dividends. Okay, these dividends are going to come out. They're going to be guaranteed every year, kind of in the more favorable projections, perhaps. It's going to increase the cash value this much, or we're going to offset premiums this way. And then after it's all said and done, of course, the calculations show that it's going to outperform buying term and investing the difference. There are a lot of different variables that could kind of be tweaked a little bit to build that narrative. I think there's a couple of things to think about, and like what you're looking for is exactly like the details on what the assumptions are. How realistic are those assumptions? And then kind of thinking about the narrative too and the way it's pitched. Okay, you're going to have a whole life policy. We're going to create generational wealth because it's going to be a tax-free inheritance. Not only that, but you're going to have tax-free income coming out. It's like, let's check a couple of those assumptions for a little bit, because tax-free income, how would it come? It would come in the form of a loan against the policy. You can't have your cake and eat it too, in the sense that you can't take a loan from the policy, never pay it back necessarily without consequences, and have your whole death benefit and say, okay, well, I'm going to have tax-free income from the entirety of my retirement and also leave a massive inheritance for children, because the loan amounts are used to cash value or the death benefit amount. If you take out too large of a loan for the policy and it were to lapse for any reason, you could be facing some kind of taxable event, right? Where maybe the difference between the surrender value and the basis tax at ordinary income. So there's kind of a threat there. You're paying it down. And so I think because of the fact you can't truly have your cake and eat it too, you can't, I mean, you can in a way. What it's not the rosiest picture of taking lifetime tax-free income and then having the full death benefit. I think you really start to weigh, well, if I need insurance, does it make more sense to get a term policy that's 10th of the cost and then investing the remainder, which I know is kind of a basic thing to say, but that's really what you have to evaluate is, if you can't have your cake and eat it too, your whole life policy, 100% on each side of that, then does it make more sense to truly go pure? And I think a lot of times the answer is yes.
Yeah, I think when you look at whole life versus term insurance, you have to understand that the insurance broker is offering you an insurance policy. It is an insurance policy at the end of the day, and that this policy has to answer an insurance problem. And if you don't have an insurance problem, or you don't have an investment problem, then whole life might not actually be the answer. And you might have to go to term because you need a life benefit and you get life insurance benefit because that's the problem that you're trying to answer and not truly an investment problem. So you said if you have this life insurance policy and you're taking a loan out and you get this tax-free income and everything looks rosy, you get tax-free income and you're spending money, and all of a sudden you be like, well, I don't want this whole life policy anymore. You let this policy lapse. All of a sudden the IRS is going to come after you because the policy lapsed, and now they're coming for with a tax bill on income that you've already spent or don't have. Because now this spent income bill is coming and you have to cough up the liquidity or you're some serious problems. So this is the added risk that comes with these whole life policies that, of course, the insurance agent is going to look at, give you this packet of papers that show, well, this is what's going to be your return as long as the market returns 10%, and you're going to be able to withdraw $100,000 per year at age 60. Well, you should probably stress test that as well beforehand. Well, what happens if the market doesn't return 10% and return 6? What happens if I need to start pulling from my the cash value of the policy at 55 instead of 60 or 65? Or what happens if the market has a sharp downturn as soon as I want to pull from? These are all things that you should stress test and not just take the numbers that they give you at face value and really understand the benefits of full life, because there are benefits, but the added risks that you are kind of putting on yourself and or your estate at the end of the day, versus something that's a little bit simpler, like term, that you plan out when you want it to end, and as soon as it lapses, then good, because hopefully at that point you have assets that can be passed out to your heirs that did the exact same job, and now you'll have that added risk. And that's going to wrap up our speed round. A big thanks to all of you who sent in these questions. If something we covered today raises a question for you, or there's a topic you'd like us to dig into for detail, send it our way. We read everything that comes in, and question like yours is what makes this show. Stefan will be back next week with a regular format. Until then, thanks for listening, and we'll see you next week.
The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.